What's going on, everybody? Welcome back to the Loan Lads presented by Park Place Finance. My name's Connor.
And I'm Joe. Last week we kind of gave an intro on who we are, what we do, really what hard money is in general. This week we're going to try and deep dive more into our main product, which is our fix and flip or fix and hold product that a lot of investors use in different scenarios, not just your classic buy, rehab and sell. So let's get into it.
The Loan Lads is brought to you by Park Place Finance, a nationwide hard money lender specializing in fix and flips, ground up construction, and DSCR rental loans. Learn more at parkplacefinance.com. All right, Joe, so tell us what a fix and flip is.
Real estate method, just kind of like, buying and holding rental properties where investors are going out on the hunt for a distressed property. So something that needs work, maybe has deferred maintenance, maybe got flooded if you were in the Florida hurricanes, something along those lines, to where the property is needing a bit of TLC to then get to market standard to either sell the property or refinance the property. So what this real estate strategy does, it basically builds equity into every property through doing rehab. And it allows investors to increase property value and either take profits on a sale or refinance and actually build equity to help pull cash back out of that property when they come to a refinance stage. And this is probably what everybody thinks every real estate investor does, is kind of like the groundwork of real estate investing 101, I would say. Fix and flips are a great tool to either, number one, get started in the real estate game, or if you master it like a lot of our clients do, it can be a full living income that you can bring in every single year and continue to keep flipping. So, Connor, when someone is looking to perform this real estate investment strategy, the fix and flip, what really is the loan product, and what is a fix and flip loan in itself?
Yeah, so I think there's a lot of loan products out there for fix and flips in general, but I think kind of the main one that people use on the hard money or private money side is kind of your short-term 6 to 18-month term loan. Those are typically higher interest rates as they are interest-only loans. Interest rates, again, can range anywhere from 8 to 12% in today's market. And what those look like is it allows the investor to get in. They can finance the rehab. So typically, depending on what the lender's kind of leverage exposure is, they'll go anywhere from 80 to 90% of the purchase price, and then 100% of the construction funds on the project, which allows the client to get in at a lower down payment, a little bit higher than a normal conventional loan like an FHA or anything else where you're putting 3 to 5% down. It's typically anywhere from 10 to 20%, but you're getting 100% of the construction finance that it needs to fix up that property. So whether you're financing paint, flooring, kitchen cabinets, countertops, you name it, it can be included in the budget. That's really the structure of a fix and flip loan, and that's what's lucrative to these clients, is they don't have to come out of pocket on the construction cost itself.
So yeah, that would work perfect for someone that maybe wants to expand their fix and flip business, right?
Yep.
I see it time and time again where maybe someone's got a large retirement savings and they have enough liquidity for a lot of the reserves, and then they have some in a checking account. Maybe they'll liquidate that 401k every now and again. But the fix and flip product really allows them to scale their business instead of having all their funds in one property at one time. It actually allows them to spread those funds across 5 or 6 different projects at one time, really giving them the ability to expand their business quicker than actually just using their own capital. And really one of the main reasons why myself or you would maybe use a fix and flip loan is you got to think about your cash on cash return, and actually using a fix and flip loan, your cash on cash return is much higher than if you were to do something like this in cash. Yes, there is some higher costs involved and you are paying interest on these funds. But again, like you said, it's a 6 to 12-month loan, right? Yep. And the goal of it is to bridge the gap between buying the property, construction, doing rehab, and then actually selling that property. So
yeah, and I think one thing that we haven't really touched on yet too is the non-Dutch aspect. So not only can you borrow the construction funds, you actually don't have to pay any money on it. So
I think we need to go back to what Dutch and non-Dutch is. It's like your left and your right.
So non-Dutch, just to clarify for everybody watching, is it's the way the loan's structured where you're only paying interest on what you draw. So you're going to have an initial loan amount towards the purchase price. You're going to pay interest on that amount, right? Mm-hmm. But let's say you have a $100,000 construction budget. Until you take a draw, you're not actually paying any interest on that $100,000 borrowed. Whereas Dutch would mean you're paying interest on the full loan amount that you borrowed day one. So whether you've used the construction funds or not, you're paying on those funds.
Yeah. So it's really there to keep holding costs down.
Correct.
Of the project. And if people don't really know what a draw is, the way construction funds work in fix and flips, ground up constructions, this is pretty standard across all lenders. The lender is not just going to give you the funds up front at the time of close and say, all right, you got a budget of 100,000, here's 100,000. So we don't know if you're going to go to Vegas and put it all on black and see if you win it. We really don't know what you're going to do with those funds, right? So the way a lender protects their investment into the deal is they will only reimburse construction funds once work has actually been completed. So, for example, you got flooring in your construction budget. You go put down the flooring in your line item. It's $40,000 for flooring. Once that has been done, the borrower requests a draw, and then we as a lender would then release that 40,000 back to the client to then move on to the next stage of the project. That way we know our funds are going into the property, which is what we underwrote to, which is how they get their after repair value, right? Which is your ARV of the project.
Exactly. And I think one other thing to touch on too is like, why is somebody enticed to use a fix and flip loan, right? Especially on the hard money or private money side. And I think the biggest reason that we see in today's age is a lot of traditional lenders, right, your conventional banks, will not qualify a fix and flip because they're typically undervalued properties that are distressed. Something is materially wrong with it, right? Mm-hmm. So whether there's foundation issues, roof issues, or it could even be as simple as like cosmetic issues, right? A lot of times they won't qualify it because it's not move-in ready. Therefore, they have to find alternative financing, which is why they would seek, a hard money or private money loan on the fix and flip side of things.
Yeah, for sure. And then one other big thing I would say with the use of the hard money loan for fix and flips, if you're an investor or you're getting new into the game, you know you got to put a lot of offers out there, right? I know people that are writing offers 100 times a day, so whatever it may be, to try and get that one property under contract. There's a preconceived idea that sometimes financing can get in the way of being a competitive offer. Using private money or hard money, whatever you really want to call that, it can technically still be a cash offer because it's not through a conventional bank. And along with that, the time to close, again, you're looking at around 3 to 5 days in terms of a fix and flip hard money loan to actually get from soup to nuts there. So
5 to 7 days. I hope everybody heard that.
Well, I said 3 to 5. We can do it 3 to 5. While fix and flipping is all sunshine and rainbows, right? That's kind of what it's perceived to be in the real estate industry, which it is for the most part. However, there is some certain things that every investor should be looking at and should be trying to avoid or trying to get ahead of to make sure they're not put in a bad situation in terms of a fix and flip. So, Connor, if you want to go through a couple of those items and just kind of give people a heads up on what they should be looking for or maybe what they shouldn't be looking for when evaluating a fix and flip loan or even being into the loan and actually into the construction project.
Yeah, I think the first thing is not overestimating your ARV. I know we touched on that on episode 1, but that's kind of the biggest issue that we come across a lot of times. And the lender is really there to kind of be the backstop and help facilitate that and make sure that we're not overestimating, right? We'll get an appraisal on it. We'll make sure that your ARV makes sense for the market and kind of what you're going to market it at when you try to sell it. But for you as the borrower or investor, kind of up front when you're running numbers and trying to put something under contract, should always be cognitive of your ARV and run very conservative numbers.
For sure.
And how do you do that? You look kind of at the marketability of the property. So take a look at let's say you're buying a 3-bed, 2-bath, right? You want to go look at comps in the area that are 3-bed, 2-baths, similar in square footage.
Yeah.
You want to see what those properties are selling for and how long they're on the market when they are listed for sale, right? Especially when you're getting into a fix and flip, like we said, a short-term loan, 6 to 12 months, maybe even 18 months, the latest. You have to get in and out very quickly, right? So if your renovation timeline, let's say, is a heavy renovation project that's going to take you 6 months, you need to have time for that property to be on the market and sell in a reasonable amount of time before your loan matures. So that's kind of the biggest thing that we always are very kind of pressing on for borrowers, is make sure that your ARV is accurate. As a lender, we're going to look at that number up front. We're going to see if it's accurate pending an appraisal. And then once an appraisal comes in, we'll evaluate that and also make sure that those numbers are accurate, right? We always want to look for a 20 to 25% gross margin. Now, obviously, in today's real estate market, it is very hard to do that. We see a lot of investors who get it, but really kind of 15 is the magic number that we're looking for.
Yeah, and going off that ARV as well, as a investor, you always want to see the best returns, right? And you want to say it's the best deal of the century. Always think of your deal as the worst deal of the century, and if it works, is good. As a lender, there's a preconceived idea that you kind of have to sell your deal to us as a lender. That's really not the case. We are going to look at the same things that any investor should be looking at on the project, and since it's a partnership, both of our funds are going into the project. We're going to vet the property probably more than the investor is going to vet the property, and the values is the biggest thing. So Connor's completely right. You should definitely run your numbers prior to getting something under contract, so you're not wasting your time getting something under contract, going through the process, and then it comes down to a value not hitting. And we can give you some more tips on kind of how to evaluate an after repair value through the likes of Zillow, Redfin. Super quick search takes us as AEs 5-10 minutes to actually get a comprehensive search of any given property. ARV is super important. However, that may not be your exit strategy, right? So from right at the start, I said fix and flip or fix to hold. If you're planning on holding it, the ARV still matters, right? Because that's where your after repair value is going to be. That's going to tell you how much equity you're going to build in the property through doing the rehab. However, if your strategy is to then hold that property, you want to be making sure that you're looking at rental comps, right? And that your rent upon completion is going to cover your debt, right? So your PITI, your principal, interest, taxes and insurance, if that's going to be your true exit. Main thing is, don't think the deal is the deal of the century and the highest in the market. Be conservative with your numbers and actually do the research yourself.
Yeah, and I think so. One thing you're trying to touch on is the fix to flip or fix to rent. Kind of the keywords at the end there, flip or rent. Exit strategy, that's kind of another big thing that borrowers or investors need to figure out when they're getting into a project. It's always good to have kind of a nailed down exit strategy, right? If you're going to sell, make sure you're buying the property at in a market that you will be able to sell in a quick amount of time. Or if you're looking to rent, make sure, like Joe said, that there are rental comps there that support your ARV, to where your debt to income is or actually your income on the property is covering the debt, right, that you have on it. That will allow you to exit the property in a quick manner, but also, have a potentially cash flowing property, right? So you always got to run kind of both sides and figure out your exit strategy up front and early. And also, make sure that there's a pivoting point too. Let's say you're trying to sell it, but the market kind of softens a little bit. Do you have a viable exit as a rental property, right? So you always kind of want to run both sides of those numbers to make sure that there is an exit there. And then the last thing I wanted to touch on the fix and flip side of what borrowers and investors should be looking at, and this is a very important piece, is the rehab budget, right? What construction, what renovations need to be done on the property? We come across it time and time again where borrowers try to get a property and maybe they are trying to underestimate the budget because they want to keep costs low, when in fact maybe that there are some items in the property that need to be fixed, right? And have material defects or issues on the property that maybe they're overlooking. Or vice versa, even worse, you could overestimate your budget, you borrow too much money, and now you're kind of stuck in this hole where you didn't even use, 25-50% of it. Now you had to pay money on it, and on top of that, you kind of put yourself in a hole whenever you got to go refinance, right? Let's say you borrowed $50,000 extra and you only had, a profit margin of 50,000. Well, if you now owe that, it could put you in a bind, right? Give us some stories here on what you've come across on both fronts there.
Yeah, for sure. First of all, I want to go to the underestimating side of a construction budget. Typically you're going to do a couple of walkthroughs. I would highly advise bringing a general contractor through with you to give you an estimate. At the end of the day, you're an investor for the most part. You will gain knowledge of construction, but I always say I'm not the one swinging the hammer. I'm not the one that's the expert on doing the rehab. Let's get an expert in there that actually knows what they're doing. But I've seen really the most recent story was one of my clients. They had underestimated the rehab budget grossly. And on top of that, unfortunately, they pulled back the drywall and there was a bunch of rot there as well, which again increased their costs. And unfortunately, there was timeline creep as well. So it took them a while to get some permits on the property. They had grossly underestimated the costs, so then they were coming out of pocket for those additional costs that were not allocated in the rehab budget. And again, as a lender, one thing we do not do is add additional funds to the rehab budget post-close, because we underwrite to that specific budget. We don't underwrite to a budget plus some. So that borrower unfortunately had to come out with those additional funds to get the property up to livable standard. And then it sat on the market for a while. Luckily, they did happen to go over their, I think it was a 12-month term. We helped them with an extension just due to the fact that they'd actually finally completed the property and they had it on the market ready to sell. But that was a situation to where if the property wasn't in one of those liquid markets and was sat on the market for a while, they were completely out of funds, potentially not even able to make their monthly payments, and they'd kind of run out of all the additional reserves that we look for as a lender to try and mitigate issues like this. But they could have put themselves in a really big bind just because they underestimated that rehab budget there.
Yeah, I think we all have some war stories on the rehab side. I've even had a client, first timer, and now it's funny that we say that. We've done probably 5 or 6 projects for them now, but the first one ever was a disaster, right? The appraisal didn't catch that there was foundation issues. There was actually a crack in the foundation that nobody was really aware of.
Which they don't. I would always check foundations.
Yeah, get an inspection.
Get a foundation
on the
inspection.
Property. But they didn't, and they waived their inspection. And so we did not account for foundation on the budget. So the borrower went into the property and had a contractor go out there and start the work. And when they realized that there was foundation issues, they ended up getting a foundation report, and that's when it came back for what it was going to cost him. It was going to cost him about $26,000 to fix the foundation issues, but the profit margin on it was only about $35,000, which again took probably an extra 2 to 3 months on his project timeline, which was additional costs of capital, right? Additional months worth of payments that he had to make. So before he knew it, when he got out of the project, a project that was going to make him, $35,000 really only made him probably a net zero. He didn't lose money, but he didn't make any money. And again, that was kind of a situation where it didn't really go great, but it didn't go south to where he ended up losing money. But it was definitely a lesson learned for him, and he's learned that lesson now. And I will say their budgets are great now.
That's really the biggest piece to whether it's even ground up or fix and flip. I know we're focusing on fix and flip today, but that's a huge piece of the loan. Get your budgets right, get your budgets as tight as possible. Number one is going to help you with the backside in terms of your draws. If it's nice, clean budget with line items that all make sense, that are actually covering what the true cost is going to be, maybe with a little bit of a buffer, right? We as a lender, we don't mind seeing a little bit of a buffer on certain line items to where maybe it's a little bit over what the true cost is, but it's in place for items to where there is a contingency built into the budget to make sure that the client's able to continue moving through that project with decent cash flow.
All right, Joe, so let's talk about why getting financing lined up early is so important for real estate investors.
I would say the first thing is getting financing lined up early. Number one, it allows you to have a professional on your side in terms of the financing piece. We kind of just went through earlier in the podcast how the lender is going to vet the deal more than you as an investor. And typically, I always say if the hard money lender is not willing to lend on the property, it's probably a bad deal for the client, right? The interests of the lender and the client are very, very similar in terms of the outcome that they want in every single project. So getting a relationship with an investor early, it's just another set of eyes on your deal, right? It's especially for new investors, having the ability to call someone like myself or Connor up and say, hey, I'm looking at this property, here's where I think the numbers land, and then us do an internal search, comp search. We look at the area, we know the markets, we can see pictures of the property. That gives some reinforcement to a new investor or even like a seasoned investor. Hey, it's always good to bounce ideas off each other and actually be able to vet that property with somebody else. So number one, that's the first thing. You can vet a deal up front with a dedicated professional. This is what we do all day, right? We talk numbers, we talk shop, we talk properties. Secondly, once you actually do find that property, already having an established relationship, we're going to be able to get you a pre-approval letter on the spot, right?
Yep.
You can go take that to the seller, get the property under contract, you're moving already within a day. We already have your docs and we're going to close the loan in 5 to 7 days there. So super quick turnaround time.
And the last thing that's important regarding kind of getting financing lined up so early is the speed to close. Again, so if you get a property under contract without having a lender lined up and you're shopping it around or trying to get a lender to get you pre-approved after the fact of already having the property under contract, that could be a 2 to 3, 4 day process, right? As we kind of mentioned earlier in the episode, we can close very quickly, 3 to 5 days, 7 max. So on that side, we would have already had your property basically ready to close at the finish line at that point. So that's why it's so important to have it set up early.
All right, so to finish out, I think we should go into what we're seeing in the market currently for the fix and flips. And right now, what's the date? We're in August of 2025. So listeners that are listening further ahead, this is kind of where the market's sitting right now.
Yeah, I think if you look at the market today, kind of what we're seeing on the fix and flip side of things is a lot of properties sitting longer on market right now currently. So sellers are having to reduce prices a little bit. So we want to make sure investors are accounting for that. And it really depends on your market, right? At the end of the day, you need to, when you're finding this next investment property of yours, you need to look at the market as a whole. Look at the average days on market. Make sure you understand how long is it going to take your property to sell on average based on that market you're buying in. Make sure you're looking in suburban areas. We're seeing a large days on market for rural areas. Sure. They're a lot harder to sell. So suburban's going to be a lot better for your exit. Even if you're an investor looking to rent out a property, right? If you want to go Section 8, go look in areas that are common for affordable housing so that it matches your exit strategy.
Can you give us some examples of that?
Yeah, so I think, for example, if you are looking for Section 8, you want to go to a larger city that has a lot of Section 8 rentals. So, for example, Chicago, Detroit, Philadelphia, those are common markets for Section 8. And if that's not your thing, that's not your thing, right? And that's not every investor's exit strategy. It's picking up in St. Louis as well. So markets like that, I think one type of strategy that we're seeing from a lot of investors right now is the college housing. So, for example, Texas A&M graduate here, College Station is picked up for Airbnbs and even long-term rentals in general. So we're seeing a lot of investors come in and buy distressed properties there, fixing them up and turning them into rental properties for college students. Markets like that are very popular right now, and I think that's kind of what we're looking at for investors. But I think the biggest thing in today's day and age is days on market. That's the most important thing. If you're buying a house that takes 180 days average to sell, for example, South Florida right now, those days on market have significantly increased. It's becoming very hard for investors to exit those short-term loans if they're trying to flip or even maybe built a ground-up home and are now trying to sell it for profit. So that's just one thing to kind of keep an eye on as we go into the coming months.
And then can you touch on real quick just some markets that we're seeing regularly in terms of inquiries, in terms of deals that we're actually funding? I know I could name a few, but
yeah, I think just to touch on a couple of markets that I think we've seen kind of an uptick in, or are markets that we see kind of frequently for fix and flip investors. Atlanta, Georgia, I think is the biggest one.
Yeah,
profit margins are high. Days on market are low.
There's a lot of inventory as well, so you can. The areas like Atlanta, areas like Florida as well, there's a lot of inventory of distressed properties that can be picked up and turned and flipped. So.
Yeah, and I think even you can go all the way kind of up the East Coast. North Carolina, South Carolina are phenomenal markets. Kind of pushing over to central U.S., you're looking at Texas, Tennessee. Those are good markets. Obviously, California has always been a great market.
We talked about some tips, tricks, and some downfalls of fix and flip lending and fix and flip investing. Give us a like, a share, a comment.
And if you're ready to flip, go check out parkplacefinance.com.